In fact, yesterday I tweeted out something about Citibank, Citi Research, and they're calling for $35, I think, by the end of this year, or yeah, really like sort of near medium term, and then $40 next year. I actually happen to agree with them. I'm just surprised that, to see someone like that come out and say it. And so if we're seeing that at those kinds of banks, the mainstream and larger banks, I thought, okay, well, this is the time to get cautious, right? Because that's typically what they are, is contrarian signals, at least in the very near term. But as I say, I do agree with them. I think it's coming, and I think that to see that from someone like that, to me, demonstrates that we are in this phase where it's becoming part of the larger conscience of investors.
The outlook for interest rates has shifted, with the Federal Reserve expected to cut rates by 25 basis points in November and December. Despite this, gold prices have remained stable due to geopolitical tensions, particularly the conflict between Israel and Iran. The upcoming U.S. inflation data is unlikely to lead to more aggressive Fed rate cuts, so gold prices are expected to be influenced by geopolitical risks rather than economic factors. Meanwhile, silver extended its gains toward $32 during Monday's European session. According to Peter Krauth, author of The Great Silver Bull and a former portfolio advisor, silver often benefits from rate cuts. He notes that while gold performs well when rate hikes cease, silver tends to excel during periods of monetary easing, typically rising around 32% within 24 months of rate cuts. Despite concerns over a potential recession, silver continues to show strong potential, particularly as markets anticipate further monetary easing. Krauth also highlights a historical pattern in silver's performance during economic cycles. Silver tends to outperform gold just before a recession, underperform during the downturn, and then outperform again during the recovery. This trend is closely linked to central bank rate cutting cycles that coincide with economic recessions. The robust U.S. employment data has raised questions about the Fed's next moves. The Fed's recent rate cuts and a weakening U.S. dollar were key in boosting precious metals prices, especially in September. Silver's correlation with monetary policy and its performance in different economic conditions make it an asset to watch as the Fed navigates a complex financial environment. Geopolitical uncertainty and potential monetary easing will likely keep gold and silver in the spotlight for investors seeking safety and returns. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
The last time, we had a significant recession was obviously 2020, when COVID hit, and industrial demand barely dropped. I mean, if I look at the numbers, I actually ran them before we started this interview. Silver demand for industrial purposes was down 2.5%. If you look at the kinds of deficits that we're facing, structural deficits, that's basically insignificant, right? Because we're at deficits that are about 20% of supply, which is huge. And there was just some news out this morning by Metals Focus, who does the research for the Silver Institute. And they said that they think that over the next 5 years, not only will the deficits persist, they will likely reach new records over the next 5 years in terms of deficits. So it's very much in one direction in terms of how this is all leans. I will say, if you look at what has happened also historically, you said, okay, 2008, 2009 financial crisis, you're right, silver took off. If you look at 2020, so let me back up for a sec. Typically in recession, some really good work was done by Incrementum on this, Ronnie Stoffeler's group, who writes the In Gold We Trust report, and they looked at how gold behaves before and after recessions, and during, and then looked at silver before and after recessions. And we also know that rate cutting cycles from central banks start right around the time of recessions. I mean, that's not an accident, right? So what's interesting is that silver does, it actually outperforms typically for a little while before a recession, outperforms gold, underperforms during, and then outperforms coming out of it. And then if you look at rate cycles, so when I saw a chart that they had put together on gold, how gold behaves in a rate, either when the Feds stop raising rates, so they just kind of go sideways for a while, which we've had for some time now, until a week or two ago. Gold does really well as of that point. Silver does well, but not nearly as well as you reach the rate cutting. So gold does really well when the Fed starts to cut rates. Silver, if you look at the last three recessions, the last three rate cutting cycles, silver did on average, which is still pretty good, 32% over the next 24 months. But when I saw their chart on gold, I said, hey, why don't I do the same? It's not hard. Let me just go and do the same, run the same numbers for silver. And it was phenomenal. If you look at a rate cutting cycle, when silver bottoms, it's usually around the middle of the rate cutting cycle. So let's say it lasts 12 to 18 months. So let's say 6 to 9 months in, typically silver will bottom. And the returns are just fantastic. So if you look at the last three recessions and you take the trough in the silver price, which is about the middle of the rate cutting cycle, silver was up on average the last three cycles 332%. So that's very bullish if you think about it. I do think we're likely to go into a recession. And despite that, silver has very, very good prospects. So it doesn't worry me. We also know that what's popular, when they start to print again, which they will, to try to get us back out of a recession.
After ending 2023 well above the critical $2,000 per ounce mark, gold has maintained upward solid momentum in 2024, consistently reaching new price milestones each quarter. In September, gold surged to a record high, surpassing $2,600 per ounce, following the U.S. Federal Reserve's decision to cut its benchmark interest rate, the first cut since its aggressive rate hiking cycle began in 2022. While this price surge has thrilled many market participants, some investors have been disappointed by the performance of gold stocks, which have not kept pace with the metal's dramatic rise. Peter Krauth notes that physical gold has performed well. Still, stocks of gold and silver producers have lagged. He attributes this to investor focus on sectors like technology and artificial intelligence and the limited impact of central bank purchases on mining stock prices. Adrian Day from Adrian Day Asset Management suggests that historically, gold stocks have performed well during most recessions since the 1960s. Even when they declined, the losses were modest, 2 to 5%, while gains during recessions were substantial, 30% to 187%. This indicates the potential for a strong rally during a future economic downturn. As central banks continue to favor physical gold as a hedge against economic uncertainty, and with the prospect of further monetary easing, gold producers could see renewed investor interest, especially if market conditions shift toward recessionary trends. Let's get back to the interview.
If you look at 2022 and 2023, if my numbers are right, we were at over 1,000 tons of gold being purchased by central banks. This, if you look at this is a bar chart, and if you look at the prior years, this is like way off the chart. And so I think we're on pace for something similar again this year. That really tells me do as they do not do as they say. So, they'll disparage gold, but they're buying it hand over fist, and they can print all they need to go out and buy gold. And it suits them that the market's quiet because they can buy it. I mean, we are at all-time highs, but hey, when you have a printer, a money printer, who cares what the price is, right? Just print what you need to go out and buy it. So that's part of it. I think also that what's interesting is that if we try to understand, this kind of goes back to a previous question, the stocks in this sector, right? The gold producers, the silver producers, why have they not performed? Well, in the stock market, the interest is in what's been performing, and that has sort of continued to perform, and that's tech, AI, et cetera, et cetera. In the gold market, it's the physical that's been performing. So you've got central banks piling in. To some extent, you've got sophisticated investors coming in and buying the physical. And central banks don't buy, for the most part, don't buy stocks or don't buy mining stocks, right? So it has not, in this case, translated into, pushing values up for mining stocks. It has been, for the most part, limited to the metals themselves. I think that's eventually going to change, and for the reasons that I explained earlier. So sentiment will shift. That just makes the opportunity that much more attractive. And as I say, some of the really smart money has started to realize that. They're going to continue to realize that over the next few quarters. I think just think gold at all-time highs at say $2,700, what that's going to look like when these large producers that, as I mentioned before, have the highest cash flow margins of any sector in the S&P, start to report quarterly profits with gold at all-time highs. I mean, I just think we need to be ready for that. Just think what that's going to do. And it's going to be harder and harder to start ignoring the sector. And I think that there are multiple reasons why silver outperforms gold in bull markets, and that's one of them. It's cheaper, obviously a lot cheaper on a per ounce basis. And so people will see gold go to 3,500, and they'll start to pay a lot more attention and think, geez, I should buy some gold, or I should have bought some gold. And what am I getting for $3,500? What else can I buy? And silver is that obvious, alternative that's just sitting there. And then they start to realize at that point, maybe it's 50 or $60 an ounce. That still looks a lot more palatable than $3,000 an ounce for gold. And that's, I think, one of the reasons that you see silver move later, but also move more as the market matures. And if you look at where silver is, if you go back to 1980, so you've got this very, very bullish, what we call a cup and handle formation. And so the start of the cup was 1980. It troughed, went back to, say, $50 again, roughly in April of 2011, and then started to drop and formed that much lower trough, which was the handle. And so that handle is forming very nicely. It's a textbook kind of formation. And I want to quote in quotes some work by a great technical analyst, Jordan Roy Byrne, who does fantastic work in my view. And he considers silver to be one of the way it's behaving and what it's likely to do. He says this is likely to be one of the all-time most significant breakouts we've seen in financial markets. So that's a mouthful. But given what silver has done in prior markets, the kind of runs that goes on and how that translates into the stocks and so on, I think we're in for one heck of a ride going forward.
As both gold and silver continue to react to global geopolitical tensions and shifting monetary policies, their roles as safe haven assets remain solid. Silver's strong performance, especially in response to rate cuts, highlights its potential in the current economic environment. With monetary easing likely on the horizon, investors will closely watch how these metals perform amid geopolitical risks and financial uncertainties. How do you think further interest rate cuts and ongoing geopolitical tensions will shape the performance of gold and silver in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.